Thanks so much for joining us for our next Ripple Ventures Tank Talk with Lo Toney from Plexo Capital to discuss how emerging managers can balance long-term success versus short-term gains in venture. Thanks for joining us, Lo.
Yeah, thanks for having me.
Now, just a quick background on Lo. Lo is the founding managing partner of Plexo Capital, where he's been for the last 3 years, which is a hybrid venture fund investing as an LP into early stage venture capital funds and directly into early stage companies. Prior to that, he was at Google Ventures, also known as GV, where he was for 3 years. Prior to that, he was at Comcast Ventures, where he was a partner at their Catalyst Fund for a year. And before that, he held roles as a GM at Zynga, and he also held executive roles with Nike, eBay, as well as startups funded by top-tier investors. On the personal side, he received his MBA from the Haas School of Business at the University of California and received his BS from Hampton University in Virginia. Let's hop into it, Lo. Can you tell us about your operator journey, starting out working in product and marketing leadership roles at firms like Nike, eBay, and Zynga, and the lessons you learned as it relates to startups and the challenges they face?
Sure. So I've mentioned this many times before, but I believe that for someone that wants to go into early stage venture capital investing, there are a lot of different paths that one can take. And I've seen different people embody successes within those different paths. I think when I give feedback, I try to tell people that you always have to understand the context from where someone's coming from. And when I started my journey into venture, it was a result of being exposed to some great VCs at Cal who came in to speak to the classes. I asked them, what's an interesting path or the best path? And it was mentioned that product management is a great way to go because the playbook for product management is very similar to the early stage investing playbook, kind of understanding a market, an opportunity, is there a problem that exists within it? And then what's the right solution, how to position it, how to make money from it, and all those different things. And so, I believe that it was very helpful for me to have roles in product management, P&L responsibility, CEO, because number one, it gave me the framework to be able to evaluate something at the early stage. And then number two, I believe it helped give me a sense of empathy for understanding what the entrepreneurs are going through on the other side of the table. Maybe so not so much with the roles at Nike and eBay, but I've worked at startups as well. So I do believe that it's been very helpful for me to understand technically how an entrepreneur is thinking about going after the opportunity, helps me to evaluate it, helps me to every now and then provide some useful feedback. But then also, I do believe it's built a sense of empathy.
Yeah, and it allows you to sit on the other side of the table alongside the founders instead of sitting across from them when you're a venture investor. So let's transition to that conversation about your transition to venture capital. You joined Comcast Ventures in 2015 as part of their minority-oriented venture fund called Catalyst Fund. After a career in high-profile positions at large tech firms and several startups, what was the hardest part about transitioning to the venture side after being an operator for so long?
Well, I ended up at a dinner in San Francisco. It was a pre-dinner for the Fortune Brainstorm series. And I happened to get lucky enough to sit next to Mike Moritz of Sequoia fame. And, I'm eager beaver, fresh, new VC. And I asked him, I said, hey, what would be the advice that one would give to someone in my position? And the first question that he asked was, well, where are you coming from? And I said, I was an operator. I'm wearing this, so proudly. And he was like, he kind of rolled his eyes a little hint of just a persnickety personality. But it was really around the fact that, again, you have to understand the context. And his context was based on observations of operators and their transition. And I think what he noted was that as operators, we have a tendency to want to dive right in with the entrepreneur in this case and roll up our sleeves and really get to work. And it's really not the role of the venture professional to have quite that approach. I think it's totally fine to let the entrepreneur know that, both are on the same side of the table, in it to win it, being able to provide good value. But there also has to be the ability to kind of take a step back as a venture professional and to really know how to ask the right questions to help an entrepreneur through their journey by allowing them to demonstrate the work has been done to think through these issues and provide some level of understanding around this is how the decision was made based on the information available, or even the recognition of, okay, that's something that we haven't quite thought about and probably should prioritize that appropriately to be able to either incorporate it or to provide a good explanation as for why it doesn't make sense either now or forever. It's very similar, I think, to a transition that happens when an operator joins a board of directors, maybe more so on the public company side. It's kind of the same process. Instead of trying to roll up the sleeves and hop right in, it's better to just take a step back and to understand how to ask the right questions to help the entrepreneur along with the journey. In fact, I think one could even argue if the venture professional has to hop in too frequently or do too much, then maybe the right person isn't in the seat of CEO.
Yeah, being a professional sounding board and just being there to listen rather than getting your hands dirty all the time, it really doesn't help anyone besides maybe making yourself feel better that you have the right decisions to make and execute on them.
That's right. And again, sometimes I think it's appropriate to roll up the sleeves with the entrepreneur, but usually it just should come from a different vector or a different perspective, or for a certain situation. Maybe it's more of a strategic situation around evaluating a partnership opportunity or potential financing or even a liquidity event.
Yeah, no, absolutely. I love that. Well, moving on to your role at Google Ventures as GV as a partner, focused on marketplaces, mobile, digital media, gaming, and enterprise. During your time at GV, what lessons related to investing in portfolio construction did you learn?
So GV is really interesting because the firm was very early in the application of two things. Number one, using a very data-centric approach to the entire venture process. So sourcing, the ability to think about proper portfolio construction, as well as kind of helping with the actual decision itself. And I think the thing that GV has done quite well is balancing the ability to kind of take the data across those different three spectrums, but then to still use the skill set that's so necessary for a venture professional. As of today, there are some things that I think still requires the ability for a person to do it. So really getting to understand the passion of the entrepreneur, kind of being able to, with meetings, is this the type of person that's going to be able to assemble a team and lead them? Do they have a really solid moral compass and just a really good feeling that one gets when they sit down across from them and looks them in the eye? And then obviously being able to provide feedback for the entrepreneur, to be able to have the value add from the venture professional, whether that be from their background as an operator or having participated in multiple deals. So I think that's one thing, is kind of really balancing the use of data, the qualitative and the quantitative side. And the other thing I think that the GV did really well was the ability to provide that distinct value add, initially by just having kind of the right people around the table, but then over time, building out really solid silos of operating excellence in the operator partner structure to really be able to add value within marketing, engineering, corporate development, and other types of functional areas of expertise that actually might cross the entrepreneur's mind more often than the issues that are brought up at the board meeting. So I think the combination of those two things just really showed me what excellence and institutional grade looks like at scale. And then I think what comes along with that was just the rigor around the diligence process, the ability to really dive deep into a particular area, evaluate effectively all the different companies, kind of understand, market sizing, is this big enough? A really good way to evaluate the ability for the entrepreneur to provide a moat around their business. And then obviously the ability to be able to tap into many of the great minds, from the Alphabet family, to kind of help with that diligence process. And then I think the piece on portfolio construction is really solid because we're disciples of the power law distribution of returns at Plexo Capital. And I really think that I started to really understand the importance of portfolio construction and having a certain target return multiple to underwrite against in the construction of that portfolio. And I think, GV does that extraordinarily well.
That's exciting. Wow. I'm really excited to get into that part about Plexo. Is there any one highlight? I'm sure there's many things, and obviously getting into Plexo and spinning that out is probably one of your proudest accomplishments. But other than that, was there something you were really proud of at GV?
I think just the ability to have such great relationships with one of the top firms and having the opportunity to be able to work with such a great team. But without question, the accomplishment that I think about most and that I'm most proud of is the ability to be able to have the vision for Plexo Capital, to really look at the model and have the alpha intensity of the purpose of the model, but then at the same time having this byproduct where we are able to help the diversity within the ecosystem itself. And just kind of pulling all those things together, really focusing on a product management approach to kind of thinking about, if I were to reinvent the model, what would I do differently? I saw what was happening on the institutional LP side, and I didn't really see, a lot of innovation. And I started to think about how I could take what we had started to do at GV and really create an entirely new model. And really, everyone really, and I think is right to do so, everyone focuses in on the fact that we're focused at Plexo Capital on investing as an LP, and investing directly on the LP side is into firms that are led by a woman and a person of color. And that's the headline, which is great. But there's a lot more that's happening behind the scenes with the way that we use data, the way that we think about portfolio construction. And as we think about the evolution of the model, our goal has been, we want to be the institutional investor allocating capital globally across the entire stack of financing opportunities in the startup ecosystem. So it started in Fund 1 with the LP investing and direct investing, and sourcing those direct investments from the portfolios of the Plexo Capital GP network. But we're now thinking, how do we even increase how we've added value? How do we identify opportunities within the secondaries market to be able to assist our GPs with liquidity, or to opportunistically be able to identify areas that we can provide great returns for our investors? How do we get exposure to GPs where we might have missed the funding cycle by going into their secondary, by acquiring LP interest from some of their LPs that might have liquidity needs, maybe because of a death or a divorce, or maybe a real estate transaction for a family office that needs to be financed? And then finally, being able to invest directly into the management companies of the GPs themselves, which will help address some of the needs of the GP, giving them the permanent capital on their balance sheet so that they can build out infrastructure and team in advance of a fundraise, and then also help with the GP commit. Being mindful that a lot of the GPs that we work with, they are women and people of color. They might not necessarily have the capability to stomach the 24 months without a salary. They probably were giving up a $500,000 salary, go 24 months without it while still maintaining a lifestyle, paying for fund formation fees out of their pocket, not getting fully reimbursed for those. And then, yes, by the way, turning around and making a GP commit and likely not having enough management fee to get back to that salary that they left in order to actually start this fund in the first place. We feel that we can help accelerate the growth of these emerging managers and get them to levels of success in a shorter, more truncated time frame.
When you started Plexo Capital, GV, you had this vision and mission to change the way that, underrepresented minorities and people of color got funded in venture. That mission, when you started at GV, has it changed since you spun it out and launched it, or has it sort of stayed exactly the same as when you were at GV before?
Yeah, it's exactly the same. I mean, this is one of the great things I think we look for in entrepreneurs is we've taken an entrepreneurial approach. And I mean, I really did think about this from a product management perspective around, what was the opportunity? And for us, we were focused on an opportunity to be able to take what we knew about the early stage investing opportunity, the fact that when you look at the return curve, the mean is so pulled away from the median. The median's at 5.6%. The mean's at 22.5% for investments that happen at pre-seed, seed, early Series A, like up to 10 or $20 million in round size. And so we wanted to combine that with these insights we had around Black GPs, female GPs, other people of color that were leading small venture funds. And the model really hasn't changed. It was always an alpha-based strategy. We want to be able to deliver superior returns. And we want to do so in a way that goes to a mission that I'm really passionate about, which is increasing the diversity within the ecosystem. That's a byproduct of our model. I believe that it starts at the top from the LP universe. And once we can get capital into the hands of diverse GPs, we know based off the data, their portfolios are naturally going to be more diverse. And those diverse founders are going to have diverse teams. And so once liquidity events happen, beautiful things start to take place. Number one, there are going to be employees that now have the financial confidence to be able to go and start that company. You have employees that can now write angel checks into their former colleagues that have gone to start companies, or writing angel checks into other diverse people within their network. You're putting the entrepreneur down the wealth creation path, returning capital back to the GPs who now go down the wealth creation path themselves and are able to deliver returns back to their LPs at the top of the stack, who look and say, wow, this is working. Let's double down and do it again. And therefore starting that flywheel. And this is a vertical ecosystem for Black entrepreneurs, female entrepreneurs, or other people of color that is not, that ecosystem, if you think about it vertically, it's not dissimilar to what we see in a regional ecosystem. So think of, Austin, Seattle, and Los Angeles, New York. If you look at Seattle, you have Amazon and you have Microsoft, and they spawned off a number of entrepreneurs. They spawned off angel investors, and they also were able to even spawn off people that became VCs. So you have a whole regional ecosystem that kind of, and they have the universities playing their role. And we see that similar effect happening, the flywheel effect that we call it, happening within the ecosystem for Black entrepreneurs, female entrepreneurs, or other people of color.
That's like the Shopify ecosystem in Canada. Same thing with that.
Yes. I mean, there's other ways to think about it. I think Shopify is a great way to think about it. I worked at eBay. We thought about that as an ecosystem. PayPal Mafia, that was another kind of ecosystem.
So getting into the topic of emerging managers and how they can balance long-term success with short-term gains in venture. Plexo Capital, you often help managers prepare marketing materials, pitch their strategy, and manage LP communications. What are some of the biggest mistakes you're seeing emerging managers make after closing their first fund? And what tips do you have for those managers looking ahead for their next fund?
At Plexo Capital, we feel that one of the key pieces of value that we add is the ability to help a great investor become a great fund manager. And the way that we've done that is to really identify, number one, before I even get started, there is no fund manager for dummies book. And this is part of the challenge with venture capital. It's historically been a very tight-knit and apprentice-based business. When you look at a lot of these firms, they are actually, the old line firms, the multi kind of stage, multi-billion in AUM, there are a lot of, historic venture ties to a lot of those principles where they might have learned it from a family member, or they might have been fortunate enough to be at a company that turned out to be super successful and then gone to that venture fund that invested in the company. So they've had exposure to the venture asset class for some period of time. There's another set of investors that just have not had the ability to kind of have that same level of exposure. I would even say a lot of the investors that leave to hang their own shingle to start their own venture fund, but came from an existing shop, if those investors did not have exposure to the fundraising process, the way to interact with LPs, how to do investor relations, how to actually get all the documents done with regard to fund formation, or how to have the back office to issue capital calls and prepare the financial reporting for the statements. Those are the things that are most important. In fact, when one talks to a lot of the LPs from the institutional side that have been in this business for a long time, they will actually say that, and this is anecdotal, but they will actually say it's very rare to not re-up in a venture fund because of performance. Typically, we're not re-upping because we discovered that the firm just was not ready for prime time and it's not institutional grade. And so what we like to do, again, is kind of help these great GPs, these great investors transfer or transform into being a great fund manager. So we spend a lot of time working with our GPs to kind of help them understand the process of what's important to negotiate with an LPA. What's the right process to develop a go-to-market strategy for fundraising? How does one think about where they are with the current fund and what's the profile of the LP that's going to be most attracted, but then thinking ahead to the firm that they want to build into a franchise and thinking about, okay, but who are the LPs that we need in the next fund? And then being mindful enough to know that, wow, those are institutional LPs. If we wait to start talking to them in fund 2 because they want to invest in a fund 1, then we're really waiting until fund 3. So we actually have to start those conversations now in fund 1, even though they're not going to invest into fund 1. And then how does one communicate to the LP, hey, we know you're not going to invest in fund 1, but we got to start talking to you for fund 2. Like there's a science and an art around it. The science comes from kind of understanding the universe of LPs, the pension funds, the endowments, the Taft-Hartleys, the foundations, and being able to kind of understand which ones are going to be most interested in the strategy, which ones are actually interested in this particular stage, this size of fund, what track record do they like to see. So having the mindfulness of that is the science side. And then the art side comes to how to actually communicate with the LPs, how to get around some of the tougher conversations that a GP might not have had exposure to, and to really do it in a way that, has the same tone and tenor of what that LP typically likes to hear and expects to hear. So, there is no book to this again. And a lot of it is institutional. It's in the minds of a lot of these GPs. And so what we've done is we put together a resource kit that was very helpful. But now we're seeing the opportunity to take that to the next step. And we're working on a formal program that the best way for me to describe it, my friend Michael from YC, he's a good friend. So I'm going to use his firm. We're building a YC for GPs.
I was literally thinking that in my head. I was like, this is an incubator for the actual venture funds, not the founders. That's amazing. I mean, as a GP myself and raising my first fund, you have to learn it by trial by fire, really. And nobody's there telling you, especially as a local Canadian fund, you're trying to figure it out. So it's so amazing to have people like you in the ecosystem who not only put your money where your mouth is, but also back it up with real tangible support. So I appreciate that.
Oh, thanks. Appreciate that.
One thing that we always talk about as an early fund is how you should think about emerging managers and how, portfolio construction, targeting certain return thresholds when meeting with institutional investors like Plexo Capital. So what are your thoughts on quick markups versus portfolio companies that take longer to raise capital due to capital efficiency, but you don't show those metrics in a presentation? How do you think about that?
Yeah, so I think there's a couple of things here. Number one, portfolio construction is actually extremely important. And one of the things that we have learned being on the job is that there's a wide variance in the level of sophistication that a GP will use in describing their portfolio construction. I've had everything from meetings where the GP will talk about portfolio construction and I'll quickly do the math and I'll say, wait, that math doesn't work. And I've had an example last week where the GP kind of didn't take into account that they were only going to be pre-recycling. We're only going to be able to deploy, 85% or so of the fund. And so they were giving me portfolio construction math as if there was no management fee. And so my initial joke, I was like, hey, yeah, I like your fund because it sounds like you don't have a management fee. That's great. I'm in, but I think it's just because not everyone has had to go through that exercise. Again, this is, if you're just focused on doing great investments, then it might not have ever come up at your prior shop to really understand the portfolio construction and the art of that. And then you have GPs that are extremely sophisticated that have, kind of run exit scenarios and done Monte Carlo simulations, have kind of taken into account different scenarios for how cash flows might come back and how they would recycle them. So, there's that level as well. I think the most important thing is that there are different approaches that one can take to get to that 3x net return that most institutional LPs want to underwrite. And there is no one size fits all. For some LPs, like my good friend of over 22 years, Michael Kim, he has found success in focusing on extremely concentrated portfolios, managers that take lead positions, and he's done extraordinarily well. And then he kind of almost replicates that within the Sindana Capital portfolio construction model. We've done a deal with Michael before, Sindana, so we look at folks that are concentrated. We actually have, for us, we tend to lean a little bit more towards those GPs that are concentrated if they're focused on a particular sector and they've determined that they have extreme expertise and are able to really understand all the nuances. They're typically investing more hypothesis driven around certain opportunities. They have a higher level of conviction to write the lead checks, which means they've probably done the work to understand the universe of opportunities available and really know why their bet is going to be able to do what's necessary to build that defensible moat and win in the market. So we love those opportunities. And I would say it also translates usually to someone that has the network both on the sourcing side to make sure that they do not miss any deal that is in their sweet spot. But more importantly, those deals are probably going to be competitive. And so we also like to see the GPs, if we're going to go concentrated and go with that strategy, they got to have the value add network to be able to win the lead position in the deal. So it means they're probably differentiated in some manner to the entrepreneur in the eyes of the entrepreneur. And the entrepreneurs are obviously going to be referencing with other entrepreneurs in their network, probably referencing with other GPs. And so, that differentiation piece is usually based on the value add network. And it takes time to be able to determine that. But the one thing that is consistent is, I think people often abstractly think about portfolio construction strategy without actually realizing the importance that it plays with how an LP evaluates a GP within the context, because the portfolio construction strategy has to map to the GP and the value add, their superpowers, their sourcing network, or otherwise there's going to be a disconnect.
Yeah, you sound like you take a very wholesome approach to everything that GPs are supposed to be doing, not just the metrics that you have. You look at some of the other things, and you touched on one of them just there, and I'd love to dig into this, the lead investor role. So, do institutional investors like Plexo value emerging managers who lead a majority of their deals and are more actively involved with their portfolio companies differently than, let's say, all these angel funds who are writing, hundreds of follow-on checks? And if so, what metrics besides MOIC should they use to demonstrate that to investors?
So the first question, the answer is for us, Plexo Capital, we absolutely like the GPs that write lead checks. Now that can be, we talked about a couple of different scenarios. We talked about a concentrated portfolio GP approach, and we still, nonetheless, ownership matters. So we still like to have GPs that have the ability to write lead checks, even when the portfolio is not as concentrated. Other questions stem off from that, the ability to have the proper bandwidth, given it's probably staffed by a smaller team, a slimmer team, and then, board seats and all of those things. But nonetheless, yes, as a generic rule of thumb for Plexo Capital, our model is also predicated off of the power law distribution of returns. So the other piece that comes along with that is if we want to cast as wide a net as possible. So we want to minimize the overlap in the underlying portfolio companies, and having GPs that write lead checks just kind of naturally lends itself to that scenario. I think we do like the fact that the GPs do have often, because they might have a board seat or they're just the lead, they often do have the ear of the entrepreneur. But the ear is important, but I think what's also important is just the rapport that a GP can create with an entrepreneur. One does not necessarily need to be a lead or have a board seat to be able to truly have the ear of the entrepreneur and to be able to work for the entrepreneur. So I would say, all things being equal, yes, we like GPs that lead, but we also like GPs that are able to build a good, strong relationship with the entrepreneur, given the duration of this business and the fact that as an institutional LP, this is likely going to be a multi-decade relationship. And then with regard to metrics, we prefer TVPI because it's on a net basis and it factors in management fees. And, we see this sometimes with some of the folks that are enterprise focused. Sometimes if it's a first check-in to an enterprise company, it might take just a little bit, depending on how far along the enterprise company is when it started. There's a lot of caveats I would have to give, but yes, we try not to focus too much on some of these early metrics, focusing a little bit more on TVPI in the early days, not really hitting IRR until the firm is a little longer in the process with the fund, maybe year 4, 5 or so. Ultimately, IRR is important. And then the last piece is obviously, as my friend Chris Duvo says, the moolah and the coolah. It's the DPI. I can't pay my son's college tuition check on unrealized markups.
Yeah, can't feed my family on it. I agree. So I think it sounds like there's a combination of everything. Some of them is, quantifiable. Some of it is not. And if you can explain that to an LP in the way you act with entrepreneurs and LPs, that's a really great way to put it.
It's important to really understand how to articulate the performance drivers of the fund and kind of what the outlook is for those companies. So it's okay in the early days to kind of really show the portfolio within the context of, okay, what's the underlying portfolio companies that are proving to be extremely promising and maybe are a significant portion of the TVPI at the moment. I think that's totally fine. And then helping to provide some context and some additional color commentary around those companies, their prospects, as well as some of the other companies. It'll still be early, but I think it's just good to show that discipline and that level of understanding, particularly if one is leading deals, but whether they're leading or not, it's just good to really know the portfolio.
Yeah, I mean, the question really stems like, can you run a $25,000 check fund to a $1 million check fund the same way? And I think your answer is like, it all depends.
Yeah, it depends. And what we do is if it's a small fund, think sub $10 million or even a $5 million fund, we want to understand the GP's vision for where they would like to, or how they would like to build a firm and a franchise. And then if their plan is to ultimately have a larger fund, call it 25, 30 million, that's leading deals, but they're currently operating off of a $5 million fund, what we want to do is to see them prove the concept. So it's one thing as a GP to be able to write a 50, 100K check, slide it in, provide some value to the entrepreneur. The sharp elbows start to come out when one desires to lead that hot deal. And so then we want to see the GPs prove in that smaller fund, 5 million, sub 10, the ability to prove the concept. So show that deals that are led can be wins. So maybe lead one or two or maybe three within the smaller fund to prove that the GP can lead. Otherwise, they're not proving that they can actually make that transition.
Gotcha. This is a bit of a selfish question. How are institutional investors assessing fund managers like Ripple? Our first fund was just over 10 million. We led 80% of our deals, and we're still in the first 2 to 3 years of fund one. How are they looking at funds like ours when deciding on investing in fund two? Is it only just wait for the returns in 5 to 7 years? Or can those relationships get started earlier?
So I start talking to them right now. So go after the institutional LPs that don't do fund ones and just start building the relationship and understanding qualification questions for the LP as well. Do you do fund twos? What's your process look like? What type of track record do you like to see? Are you currently making commitments to this asset class, this stage? Give us the profile of your last LP commitment. How many LP commitments does one typically budget? Are you adding GPs right now, or is it locked and we'd have to wait for someone to fall out? I think asking all those qualification questions are really important. And then beginning to build the relationship. Obviously, if it's 2 to 3 years in fund one, there probably is not going to be a lot of DPI. The IRR might be wonky based on, timing of cash flows and certain deals that have been marked up quicker than others. So the real emphasis is going to be on the TVPI. And again, I go back to the prior comment, which is to really lay out the ability to understand, for the LP to understand what's driving the TVPI. Kind of, what are the most promising companies, case studies on some of those companies. How was the deal sourced? How did the deal get won? Who was else in the running? What was the value proposition that really stood out to the entrepreneur to help win the deal? What type of value has been delivered from the eyes of the entrepreneur post-check? Like those are the types of things that really help to get an institutional LP excited, kind of showing the discipline of the process to follow with regard to the portfolio construction as well, the discipline around the thesis, kind of the guardrails, and showing that there's discipline to remain within what was marketed to the LPs so that there's no indication of drifting away from the strategy, I think is also really important. Yeah. So, I think those are some of the most important things to do.
Yeah, it sounds like metrics matter, but attention to detail and detailing the process in which you live by every day at the fund also really matters. Don't overlook those details because it's important beyond just the metrics. So, I always love to ask for book recommendations.
There it is.
And your colleague Kate gave me this one ahead of time, so I had to put it up there. Tell us why this is such an important book for you and why people should give it a read.
Yeah, so this is a really interesting one. So this is, at the height of the, kind of the Michael Milken junk bond. the first African American to execute a $1 billion transaction is Reginald Lewis, who was actually a lawyer. He was a deal lawyer that got his start in the LBO game. I think his first deal was McCall. It was like a pattern company that my grandmother used to use it. She did a lot of, sewing of dresses. And so they had a company that were providing patterns for sewing dresses. And he bought that company. But then he bought the international assets of Beatrice, the diversified food company. Really tragic because he ended up dying from brain cancer. But his wife stepped in, effectively ran the enterprise. But I think, for me as, an African-American male growing up at that time, there weren't a lot of folks that I could point to and say, wow, he looks like me and kind of, comes from my background. But Reg Lewis, he did. And so for me and a lot of other, young African-Americans in finance or investment banking or venture capital, he's the one that we look to.
The title says it all. It really does. Why should white guys have
Yeah.
all the fun? It's perfect. Well, before we wrap things up, we always love to ask our guests for any final words of inspiration for our audience.
Persistence overcomes resistance.
That's easy, short and sweet. I love it. Thank you so much for joining us today. I really appreciate it, Lo.
All right, no problem.